Good morning, good afternoon, good evening. I'm Fred Starr from the Central Asia-Caucasus Institute at the American Foreign Policy Council in Washington and in Stockholm. And we are focusing today on the economic outlook for Central Asia and the Caucasus in turbulent times. That's what the announcement says. Well, what an understatement that is. We're better to say the economic outlook at the time of an economic tsunami, because we're dealing with world economic slump, we're dealing with inflation, rise of mercantilist trade policies in various places, the Ukraine war, which is affecting everything, sanctions, of course, and then Taliban rule in neighboring Afghanistan. Each of these factors and many others affect the outlook, and we're very fortunate to have two real experts from the International Monetary Fund, old friends of the Central Asia-Caucasus Institute, and they have just been conducting their careful review of these economies, and they've agreed to share their conclusions with us, with the proviso that everything's in a very fluid state, and in the day tomorrow or the day after, their prognoses may well be subject to change. We will be presenting Subir Lall, who is an old friend of the Central Asia-Caucasus Institute. He's been deputy director at the IMF since 2013. He's in charge of Middle East and Central Asia Department. He's a graduate of New Delhi University and a real expert on these areas, but he's also in the past had to deal with Indonesia, Korea. He's covered the world. And also presenting today will be Ron van Roden, who is a mission chief for Uzbekistan, Middle East, and Central Asia Department at the IMF. He is, interestingly and significantly, he's had serious experience also as an analyst focusing on the economy of Ukraine. So let me turn it over to the two of you in whatever order you prefer. And then after that, we'll open the floor to questions and comments from the audience.
Thank you very much, Fred, for the introduction. Maybe
I guess we lost the connection with Subir.
Apparently, yeah. Perhaps, Ron, you might be, would it be appropriate for you to proceed while we're waiting for him to reconnect?
Let's give it a minute, because my presentation follows as a kind of more deep dive into the general overview of the region.
Good.
But if it doesn't work, then let's do that.
I'm sure he'll be back on.
Yeah. I think this is the drawback of doing things still online and via Zoom. It doesn't always work.
Well, on this subject, though, it's really crucial that we move beyond anecdotes and these news blasts, which are easily subject to distortion. And frankly, it is only a few institutions globally, of which the IMF is one, that is attempting to analyze the economic fallout from all this with a dispassionate and disinterested point of view, and therefore we're the more grateful for the two of you.
Yeah, and we have, of course, been in close engagement with the country authorities of the countries in the Caucasus and Central Asia. For Uzbekistan, we were in Tashkent in April, late March, April. Very timely, I mean, given everything that is happening in the world. I mean, to discuss how to respond to this latest shock. We hope to be able to present our findings to the IMF's executive board by the middle of June, and that will be published, I mean, shortly thereafter. And same for the other countries. I mean, so we're in close engagement, and actually have, I mean, coming out of the pandemic, started to travel again to all these countries, because I mean, the in-person dialogue is so much deeper and more important than doing it like this through Zoom. I mean, we managed, but I mean, in person, there's nothing that can replace in-person engagement.
Ron van Roden, maybe you could say
Yeah,
a word about
maybe.
your prior experience on Ukraine.
Well, I mean, on Ukraine, I was mission chief for Ukraine for more than 4 years, until the outbreak of the pandemic, and where the country continued to make substantial progress in transitioning and reforming, becoming a modern emerging market economy. And during that period, I mean, the authorities were particularly very good in ensuring macro stability under very difficult circumstances. With a very strong central bank, a very strong Ministry of Finance, supported, I mean, of course, with sizable support by the international community, but with a really, I mean, dedicated government and central bank to keep sound macroeconomic policies in place. But of course, also with a lot of challenges, particularly in the areas of governance, corruption, where it always was difficult to push things ahead, and there was a lot of pushback from vested interest. But gradually, I mean, things were clearly improving.
And did you find parallels between their fate and other post-Soviet countries?
Well, I mean, in that sense, it's interesting. I mean, having switched to Uzbekistan now as mission chief for Uzbekistan. So Uzbekistan is a little bit of a late starter in terms of reforms, and so they really started with serious reform efforts in 2017 when the current president came to office, but they're going at a very rapid pace, but in a lot of ways it reminds me to Ukraine, say 10-15 years ago, in strengthening the central bank, having an independent central bank that is clearly focused on achieving low inflation, strengthening the Ministry of Finance, making sure you have a solid framework for fiscal sustainability in place. The early reforms in liberalizing the exchange rate, liberalizing most prices, and that went fairly quickly. But now coming into that next phase of reforms, I mean, the second generation of reforms, having to deal with the large state-owned enterprise sector, and creating an environment for a strong private sector led growth, and I will say a little bit more of that in my presentation. But I think, I mean, as it looks like that Subir continues to have problems, maybe it's better that I will start with the discussion on Uzbekistan.
I'd be most grateful if you would, and thank you for this very interesting background observation regarding your experience in Ukraine.
Yeah. So let me try to share my screen. Let's see if that works. All right. Okay, I think, can you see my screen?
Yes, I'm sure. And I see Subir is back.
Okay.
Yes, terribly sorry. I seem to have had some connection issues here, but Ron, why don't you go ahead and I will come in after you.
Oh, okay. Okay. I just stopped sharing, but then I'll go ahead again.
So please, yeah.
Yeah. So basically, I mean, a little bit as background. I mean, Uzbekistan weathered the last couple of years, the years of the pandemic, relatively well. Strong economic fundamentals, large policy buffers, high gold prices, but also sizable international support allowed the authorities to take strong actions to cushion the impact of the pandemic, while also being able to maintain macro stability. And with this strong fiscal support in particular and a rebound in remittances, growth in Uzbekistan accelerated from almost 2% in 2020, I mean, still positive, which was quite an exception, to more than 7% last year, and inflation fell slightly to 10% by the end of last year, owing to a very tight monetary policy stance as the central bank kept its policy rate at 14%. And real, I mean, real interest rates have been firmly positive throughout the pandemic. I mean, that's quite a tight monetary policy stance. But just as it appeared that Uzbekistan had moved past the acute phase of the pandemic, the war in Ukraine now and the sanctions imposed on Russia have brought new uncertainty and weigh heavily on the outlook. As you can see, Russia is a key trading partner and a large source of remittances and financing for Uzbekistan. Remittances were close to 10% of GDP last year, of which almost 3/4 originated from Russia. And importantly, 1 in 6 households depends on remittances as the main source of income. And remittances on average account for about 20% of total household incomes. And in some of the poorer regions, and it's actually closer to 30% of total incomes. Russia also accounts for about 20% of imports, mainly vegetable oils and sugar, but also fuel. 12% of exports, again, mainly basic fruits and vegetables and textiles, that despite Russia's economic contraction may still be in demand or could be sold elsewhere in the region. But logistical challenges have increased substantially as much of Uzbekistan's external trade passes through Russia. And alternative trade routes are few and also costly. And another channel of possible impact is that Russian sanctioned banks have been and were expected to be a major source of financing for large projects in Uzbekistan, large investment projects, mainly in the energy and mining sectors. And alternative sources of financing can, and in some cases already have been found, but in many other cases, this may make time. And of course, higher food and fuel prices will feed into inflation, which, as I said, had come down, but was still fairly high at over 10%. Go to the next slide. Let me see. That works. More technical difficulties. Okay, this doesn't move to the next slide. Let me try again. The technology is not helping today. This is annoying. Okay, this doesn't work. So let me then just do it without the slides, unfortunately. So with this new shock, we expect that growth is going to slow to between 3% and 4% this year, revised downwards from 6% that we had projected earlier, mainly as consumption and investment are expected to slow. Inflation is expected to remain elevated this year at close to 12%. But of course, and as already discussed, uncertainty is extremely high at the moment and downside risks are very large. And the risk for Uzbekistan stem particularly from a possible further escalation of the war in Ukraine and the sanctions regime. And Uzbekistan could also be adversely affected by slower growth in its other main trading partners, China, Turkey, Kazakhstan, which is going to be affected as well as further volatility in commodity prices and tighter global financial conditions. And of course, I mean, last but not least, a renewed flare-up of the pandemic also continues to pose a large risk. So what to do? I mean, to deal with this latest shock. So in the near term, macroeconomic policies need to stay focused on supporting the recovery, containing inflation, and protecting vulnerable households through what we call an appropriate policy mix. As part of this, the pace of fiscal consolidation in Uzbekistan can be slowed to provide additional but targeted support to households who will face both lower remittances but also rising prices. Therefore, while the approved budget for this year had aimed to bring the budget deficit down to 3% of GDP, the authorities now aim to slow this down and instead bring the budget deficit to reduce it to 4% of GDP this year, as I said, to allow for providing additional assistance to the economy, but particularly to vulnerable households. And despite the increase in public debt that we have seen in recent years, Uzbekistan remains at a low risk of debt distress, as debt levels remain relatively low. At the same time, the central bank's primary focus remains on reducing inflation. The central bank, as you may have seen, acted decisively in mid-March by raising its policy rate further from 40%, which was already high, to 17%, in an effort to anchor inflation expectations and to stem exchange rate pressures. And the exchange rate since then has strengthened somewhat. And the central bank, importantly, also will continue to allow the exchange rate to move flexibly and to let the exchange rate act as a primary shock absorber. Now, at the same time, what the authorities are doing, and we talked about this a little bit at the introduction. I mean, Uzbekistan is transforming to a modern market economy and has been a little bit of a late starter. And while structural reforms continued during the years of the pandemic, I mean, they did slow down. So now it's time to actually accelerate the pace of structural reforms, and which is what the authorities are trying to do. Because the goal of the authorities is for Uzbekistan to become an upper middle income country by 2030, with per capita incomes to exceed $4,000 and to halve poverty. However, red tape, weak governance, and an uneven playing field for businesses in which state-owned enterprises enjoy various privileges are a drag on investments and productivity, and they hinder the development of a vibrant private sector that can create enough jobs for a rapidly growing labor force. And importantly, I mean, the financing of growth will need to shift away from government and state-owned enterprise borrowing to private investment. And particularly as at the IMF, I mean, if we look at the balance of payments, which we typically take a close look at, we see that Uzbekistan has large current account deficits, which is appropriate for an economy in transition, because it needs to be able to rely on foreign savings, foreign investment. But we see that those large current account deficits are financed mainly by borrowing either by the government, borrowing by state-owned enterprises, state-owned banks, and that the share of foreign direct investment in financing this current account deficits is still relatively low. And that is something that needs to change if the authorities are to achieve their objective of strong but also sustainable economic growth. And to help realize that, what the authorities aim to do is to substantially reduce the role of the state in the economy. and unfortunately, I mean, the slides don't seem to work. But if you look at the relative size and role of state-owned enterprises in the Uzbek economy, and the same for state-owned banks, I mean that those ratios are fairly high compared to other countries in the world and in the region, and also for transition economies. So on the one hand, I mean this brings revenues to the budgets. State-owned enterprises account for almost half of total government revenues, but it also presents large fiscal risks. And to reduce the state's very large footprint in the economy, the authorities plan to adopt a new privatization law this year to streamline procedures for selling state-owned enterprises and state-owned banks through, importantly, transparent and competitive processes and procedures. They also want to accelerate privatization. They made a start with privatization last year. They have now sold 3 medium-sized state-owned enterprises, also a large number of smaller assets. But I mean, there is a universe of close to 2,000 state-owned enterprises, and so there is a long way to go. Now they still plan to sell a couple of mid-sized state-owned enterprises this year and next year, and also to sell shares, majority shares in a number of other enterprises. But of course, this may be more challenging and more difficult under the current environment of increased uncertainty. At the same time, for the companies that are to remain in state hands, the authorities plan to adopt a new state ownership law with well-defined ownership principles and establishing arm's length relationships between the companies and the government. But this should be combined with additional efforts to improve state-owned enterprise corporate governance. Because what we have seen is while the number of professional, independent members of supervisory boards of state-owned enterprises and state-owned banks has increased over the last couple of years, more are needed to have majority independent supervisory boards at these companies, and also to be able to strengthen the actual management boards on these companies, because these are appointed by the majority of the supervisory boards. And as I mentioned before, many of these state-owned enterprises enjoy various privileges and advantages, either by tax privileges, custom exemptions, tax exemptions, or outright monopolies and stifling competition, and that needs to be eliminated. And so that takes me to my next point, which is the need to establish, create an environment for the private sector, to be able to allow for strong private sector-led economic growth, and because with a growing population and a fairly young population, new jobs will need to come predominantly from the private sector and predominantly from small and medium-sized private enterprises, because there are not enough of these, and this is also why you see that many Uzbek workers look for employment abroad, in which case many in Russia. So priorities in this area are to further open up markets to private entry and to eliminate those advantages that state-owned enterprise have. The authorities did take a couple of measures earlier this year to open up some of the markets and eliminate a number of the tax privileges that state-owned enterprises enjoy, but clearly more needs to be done. There is also a need to move away from a practice that we see of basically governing by decree, with frequent decrees by either the cabinet or by the presidency, but to move more to establishing a solid, stable legislative framework. They're working in that direction, and like I said, there's been a new central bank law, a new tax law. They're working on a privatization law, but there's clearly more that needs to be done as well. And in that sense, more generally, there is a need to strengthen property rights and the rule of law, including by improving the judiciary and by accelerating the sale of non-agricultural land, but also establishing a market for agricultural land and improving the cadastre in that regard as well. At the same time, the authorities are pressing ahead with trade integration, moving ahead with WTO accession negotiations, and also increasing their relations with the EU to help increase and diversify foreign trade. And last and not least, what is needed also, what we hear a lot from companies, from new companies, is that education needs to be better aligned with workforce needs. It's for when we talk to companies, we often hear that it's actually difficult to expand, to grow, not only because of the bureaucracy, which is still large and creates hurdles, but also due to a lack of sufficiently qualified workers. Now, all of this is part of the authorities reform program, but clearly these are not easy reforms. I mean, they will take time and a lot of effort. And of course, I mean, the IMF, but also the other international financial institutions will continue to help them. Like I said at the beginning, the authorities have made tremendous progress over the last couple of years, but there is still a long road ahead, and a road that is not being made easier by the current headwinds coming from the war in Ukraine and the sanctions on Russia. So let me stop there, and apologies for that the slides didn't work.
Thank you. Dr. Lall.
Thank you very much, Fred, and thanks, Ron. My apologies again, but somehow I had a software problem at my end, but hopefully it works now. So I'm going to try to share my screen as well, and hopefully that should work for some time at least. So I hope you can see the screen now. As I was saying, and as Fred, you pointed out in your opening as well, uncertainty is the key theme of the day. And so what we are presenting here is our latest assessment, but we have to approach it with some degree of humility that things are still evolving. And so we will keep a close eye, of course, and keep updating, but a lot has happened since the last time we met in this forum. And so, and which are well known, including, of course, the COVID pandemic itself and its various stages, including the Omicron phase, and then the war in Ukraine. What happened, maybe just to step back for a second, what happened last year in 2021 was that the actual outturns in terms of GDP growth turned out to be better than what we had forecast and what I had presented to this group back in the fall of 2021. And they were stronger than expected despite all the challenges stemming from the pandemic, and in some cases with limited policy space. And this was mainly driven by stronger than expected domestic demand. There was pent-up demand from households and to some extent firms in these countries, and that still provided a lot of momentum to the economies. And most notably consumption, and that refers to the households, of course, and also buoyant remittance flows. And so you can see on the leftmost chart that real GDP growth turned out to be higher, the dots there, as opposed to the charts, which were our forecast at that time about 6 to 7 months ago. Meanwhile, also, since we last met, the region was hit by a fourth pandemic wave driven by the Omicron variant. And of course, not just in the Caucasus and Central Asia, but many other parts of the world as well. Confirmed cases rose quite rapidly and reaching the highest level actually since the beginning of the pandemic, but quickly subsided beginning in February. On the plus side, the variant proved to be relatively less severe and resulted in fewer deaths than in previous waves, especially in countries that had achieved vaccination rates over 40%. What you see on the rightmost chart here is that, in fact, despite this new wave of the Omicron variant, mobility restrictions were not generally imposed. And so that allowed the recovery in the economy to maintain its momentum, even coming into this year, 2022. One consequence of this rebound in activity and also the rebound in energy prices was that inflation surged in 2021. You see that on the leftmost chart here, which has headline and core inflation, as well as food inflation, which has been one of the key drivers. So the average change in headline inflation increased. It was 6.6% in 2019, and it rose all the way to 9.2% last year in 2021 in the region. So that was quite a notable rise in inflation already in 2021. And what you see in the middle chart is that in response, central banks generally tightened monetary policy, even before the war in Ukraine. In fact, the cutoff date on that chart is February 23rd of this year. So all this happened really before the war and the attendant further pressures on exchange rates and inflation, which I'll come to in a second. And on the rightmost chart, what you can see is on the fiscal side that debt has generally risen for all countries in the region between 2019 and 2021. And this has been mainly due to support for the pandemic and alleviating the impact on the population, which we had discussed last time as well, and in fact have been discussing for almost 2 years now. So that also reduced fiscal space. So coming from that background and with a robust start to the year, with strong growth, but slightly higher inflation, with strong growth and high inflation and reduced policy space, the war caused an immediate spike in commodity prices. That is, of course, well known. And you see that on the leftmost chart. And the war and the sanctions surge in several commodity prices and adding to existing inflation pressures. Oil prices also moved up. They initially seesawed a bit and volatility also increased. Similarly, gas prices skyrocketed at the beginning of the war, and food prices, as is well known, were severely impacted as Russia and Ukraine are among the world's largest exporters of wheat. And other Russian commodity exports affected were metals and fertilizers. And those, of course, have strong implications for global supply chains and agricultural production. Prices still remain volatile. They have receded from the initial spike that we saw in late February, early March, but still remain somewhat elevated and certainly are volatile. This initial shock also contributed to depreciations of currencies that you see in the middle chart. And in fact, these depreciation pressures elicited interest rate hikes in some of the countries in the region, including Kazakhstan, for example, foreign exchange intervention in a number of countries, Georgia, Kazakhstan, the Kyrgyz Republic, Uzbekistan, and also preemptive measures to support bank liquidity, for example, in Kazakhstan, and a step adjustment in the official rate by the Kyrgyz Republic. However, since then, the currencies in the region and the ruble have retraced some of their earlier movements. But weaker currencies, of course, have a pass-through effect on higher inflation overall. In general, policy rates increased in March, adding to earlier tightening that I had mentioned and in response to higher inflation. What you see on the right-hand side, rightmost chart, is the pullback that happened because of higher risk aversion and that increased credit spreads for the region, despite some recent corrections in some countries. The impact was larger in the region than for the average emerging market country, reflecting closer ties with Russia for some countries, elevated debt vulnerabilities for some others, and some other country-specific conditions. In general, financial conditions have tightened for commodity importers as they were hit by both the negative terms of trade shock as well as rising borrowing costs. So for the region, what is important is perhaps to take a very quick look at the channels. I will not go over them in detail. They're largely self-evident in terms of the transmission channels for the region of Caucasus and Central Asia. And you can see the direct channels, which are relating to exports to Russia and Ukraine, for example, energy dependence, remittances, and tourism, and financial links, as well as currencies. And of course, for the oil exporters, the oil and gas price is a positive effect of transmission, but there are other channels as well among the commodity and financial channels that are not helpful for countries in the region. Since this presentation will be made available, you can take a closer look at each of these points, but as I mentioned, they are fairly self-explanatory as they are. And so then that brings us, let's focus maybe on a couple of things, a couple of important channels. And one is exports. And Russia is a sizable export destination for many countries in the region. You can see that Armenia is the leftmost. It's somewhere just under 30% of the country's total exports go to Russia. Turkmenistan is relatively small at the other end, but all are in a fairly sizable range. The other important channel is, of course, remittances, which are large for a number of countries. The Kyrgyz Republic as a share of GDP the most, and then Tajikistan and Uzbekistan, Armenia. So remittances are important for some countries, and export destination, Russia as an export destination is also quite important. So, and that's why the theme today being of divergent recoveries or divergent performances in these turbulent times. And this to some extent substantiates why the impact is not the same across the board in these countries, because the size of the transmission channels is actually different from one to the other. And then that brings us to the revisions to our forecast for the region. Last year, we were quite optimistic about how the region would grow this year. And last year, when we met, we had forecast that growth would be about 4.1% for the region as a whole, real GDP growth. But now we marked that down to 2.6%, which is a 1.5 percentage points reduction after all. And recall that last year's growth itself was about 5.6% on average. So what we are seeing is essentially a 3 percentage point reduction in growth from last year to this year for the region as a whole. And that's on the left-hand side. And our report, which is out and available on the IMF website, www.imf.org, has more details on individual country forecasts and revisions. At the same time, what you see is, just a little bit more, this revision is mainly driven by oil importers' growth, since given that their import bill goes up and expected trade disruptions, lower remittances and tourism. And but of course, the impact is much less on oil exporters who are benefiting from the higher prices. What you can see from the middle chart is on inflation that, as expected, as you might expect, inflation has been revised up for all countries and is also expected now to remain higher for longer, reflecting this global increase in food and energy prices that we have seen since February. And for the region as a whole, we now expect inflation actually to be about almost 11% on average for the region as a whole. And the third element is that the external current account deficits are for the region as a whole are expected to widen because of higher commodity prices and lower remittances in the region. Although, of course, again, the oil exporters and commodity exporters will benefit as well. Turning to risks, so the theme has been about uncertainty. And as you can see, there are a couple of positive upside risks to the outlook, which is that higher oil prices could actually help support non-oil GDP growth for the oil exporters. And there could be diversion of activity from Russia to the Caucasus and Central Asia in terms of through in-migration, for example, that could help support recoveries. But the list of downside risks is long, as you can see on the right-hand side. The war, we don't know the length of this war, the impact of the sanctions fully. At the same time, Fred, as you mentioned in your opening, global inflation is an issue on everybody's mind. And so global financial conditions are expected to tighten as central banks in the US and in the euro area, for example, are addressing the risks from inflation. And in the region itself, with this higher inflation, and I mentioned the higher inflation projections for this year, if they lead to the unanchoring of inflation expectations, then an even stronger policy response might be needed by central banks in the region. And that would, of course, have a depressing effect on activity. Higher debt burdens at the same time also pose fiscal risks, and delivering an adjustment to that is difficult in a socioeconomic environment such as the current uncertain one. And in addition, something to keep an eye on is, given the region, the location of the region, also and trade linkages with East Asia and China, the slowdown in China could have an impact on a number of countries. And lettuce and food insecurity due to not just the availability of food, but also due to the prices of food are something to worry about, not just in this region, but elsewhere. And the COVID pandemic is not over yet, and we always have to keep in mind there could be another wave. So very briefly, the report, we did an exercise looking at the impact. I'm not going to go into detail in this, but it's worth just flagging for your information in case you want to look at the report. What would be the impact from a rise in global commodity prices and oil prices on inflation for the region, which of course is positive, but they're calibrated in a model and presented in our report. And similarly, energy subsidies, which are widely prevalent, essentially add to fiscal vulnerability. So that's a very difficult position to be in, to shield the population, but at the same time, not allow the fiscal situation to become unanchored. And then there is, of course, the impact on food security. And we also did an exercise on how global financial conditions, if they were to tighten further, what the impact would be on the external side and on the fiscal side. So, but this is just to provide an illustration, that the details are in the report. Let me finally just mention some of the themes, and a lot of these are in many ways mirroring what Ron mentioned about Uzbekistan as well, but they're true more generally in the region, which is that now in the situation we find ourselves, policy trade-offs have become more complex, particularly for oil importing countries. And with policy space limited, higher inflation and higher debt, even as global financial conditions are tightening and the recovery remains fragile. So what is needed is a very tailored policy response in each country to the multiple trade-offs, and yet not lose sight of the medium-term objectives of a recovery grounded in higher growth and better living standards. So how does one manage some of these trade-offs? The first is that there is a trade-off between growth and inflation. And so raising policy rates is required if there are signs that price pressures are broadening beyond, food and fuel, for example, or if inflation expectations are getting de-anchored. While allowing also the exchange rate to adjust to absorb some of the negative shocks, while preventing dislocation in the FX markets. It's also important in countries to monitor financial stability risks, particularly given the big changes in prices, exchange rates, and so on, and from non-performing loans, and to keep an eye on those. The second big trade-off is between debt sustainability and supporting the vulnerable and supporting the recovery, even as interest rates are rising. So there should be a gradual approach to the pass-through of international prices to domestic consumers, especially where their social safety nets are weak. And any new fiscal measures should be temporary and targeted and quite transparent, rather than generalized subsidies. Increasing revenue will, of course, be important over the medium term to ensure fiscal sustainability. And oil exporters who are in a better position have the opportunity to use the oil windfall to build fiscal buffers and avoid pro-cyclical spending. And of course, broadly, international community will need to support food insecurity risks in some of the low-income countries. Finally, structural reforms remain important, and they become even more urgent than before, as they can mitigate some of the impact of tighter macroeconomic policies right now, and to reduce the long-term scarring from the shock and the pandemic and the war. These have to address some of the long-standing issues in the region, with the efficiency of the government expenditure, the footprint of the state in the economy, and an acceleration towards digitization and integration global value chains can help. And let's not forget, climate change remains an important priority, and those have to be balanced against energy security risks. So thank you very much. This is a very high-speed overview for the region in terms of developments, current prospects and risks and policy trade-offs, and the medium-term priorities. Let me stop here and I turn it back to you, Fred. Thanks.
Thank you very much. Thank both of you very much. This is a very intense and dense pair of reports, and I want to ask, if I may, start with a question for Subir, and that is the distinction between those countries that seem to be moving ahead relatively successfully and those which are not. There seems to be a growing, am I right, segmentation in this area. And the question that I would ask is this: do you see evidence that the lagging countries, I have in mind Tajikistan, Kyrgyzstan, Armenia, so forth, the lagging countries are coming to grips with the challenges before them or not? There is, after all, a new government in Kyrgyzstan. Do you see evidence that they are facing reality and at least beginning to take the right steps or not?
Thank you, Fred, for that question. Very important issue. As you know, we just had our spring meetings, and we had the opportunity to actually, for the first time in a couple of years, meet physically with many of the delegations from the region, and in fact, indeed, from across the world. So I think there is a great sense of understanding and even urgency about the situation confronting all countries, and the delegations we met, they are very much on top of the situation and what they need to do. So certainly not a whiff of complacency anywhere, and a real understanding. And in our engagements, even at the regional level, we found that there's a very clear understanding of some of the trade-offs I mentioned, for example, and some of the policy priorities. What is different is that some countries have more room than others to act. And so the trade-offs are a little easier. Of course, the oil exporters and the commodity exporters are in a better position, and those that have built buffers. Coming on the heels of the pandemic, others have exhausted some of their buffers. So that's what makes things a bit more challenging. And we are working very closely with countries to find the right way to navigate this. But to your question, there is a heightened sense of awareness that first, that it's a difficult situation, both in terms of the growth outlook, in terms of employment generation, inflation, and the fiscal space. But we also don't know how long these challenges and these pressures will persist, because much like the pandemic, it's very hard to tell when can we say, okay, this is ended, now we can look to the recovery. So it's a question of, trying to manage and navigate these turbulent times without a clear view from anyone on when things will start calming down. Thank you. Back to you, Fred.
Now I know that you're organized at the IMF as Central Asia and the Caucasus together, and you treat it as in an organizational sense within the IMF as a region. In what sense is it a region?
That's a good question. We treat it, we look at it through a similar lens, mainly because we are housed in the Middle East and Central Asia department, but Caucasus and Central Asia are in a way different because they are transition economies. And so they have some of the challenges which are similar to the Eastern European countries in the 90s, for instance, or the early 2000s. So that's why we combine the Caucasus and Central Asia because of similar challenges of having a large state sector, large state-owned enterprises, a lot of past focus on heavy industry, for instance, limited integration in global value chains. That's kind of the reason for this treatment. But if you look at it now, clearly there are differences. Some countries are much farther along in the transition process. Some are late starters, but have been bringing in a lot of momentum. And as I pointed out in the presentation and in the chart, some have still, say, strong trade links with Russia, for example. Others have diversified away and have become bigger. I mean, the converse of that is they have become bigger parts of global value chains as well. So Georgia is an example of a country that has diversified and become much more integrated, and partly it's due to geographic location. Many of these countries are landlocked, so it is a bit difficult to be able to do that transformation. There is an opportunity there, though, that I should mention. These countries generally have high levels of education, again, another legacy, which is a positive one. And much of global trade is now, the role of intangible trade is becoming more and more important. So the role of geography may not be that limiting a factor. And in trying to join global value chains as it used to be before, it doesn't have to be all about roads and tunnels, but you can do a lot of contributions through intangibles in global trade. So that helps. And but again, so there is clearly a difference in some sense, and we wouldn't underplay that between the Caucasus countries and Central Asian countries, and partly due to trade. But we treat them because of reasons of being transition economies.
Roden, the experience of Uzbekistan, as you reported, is impressive indeed. Beginning with the fact that in 2021 they actually exceeded your forecasts. Not only they, but the region as a whole. The question I want to ask you is: do you see any evidence that other neighbors in the region are studying, learning from, adopting ideas from the Uzbek experience, or do they continue to operate as a bunch of soloists rather than as a choir?
Yeah, I mean, I think what you have seen more recently in the last couple of years, that there are more efforts at regional cooperation, regional integration. But also, I mean, what we are seeing now with this latest shock with the war in Ukraine and the spillovers from that, including the sanctions on Russia, that most of these countries, and particularly and more so the countries in Central Asia, they have very close ties, economic ties with Russia. So it's more a spoke and wheel relationship. than that they have a lot of relationships amongst themselves. I mean, and like I said, they're working on that. There is progress in that. We see more levels of cooperation between Uzbekistan, Kazakhstan, Kyrgyzstan. It's developing. There is clearly a desire to do more of that, but it's not as much of an integrated regional market where clearly there are opportunities. I mean, it's a large number of people, so it's a large market size, and so the scope for further cooperation integration is clearly there. I think, I mean, if you look at what happened with Uzbekistan, that they fared relatively well through the pandemic, is that they had strong fundamentals, economic fundamentals, I mean, good numbers prior to the pandemic. And so they had the fiscal buffers to be able to very substantially deal with that and have sizable fiscal support. We estimate that during the pandemic in 2020 and 2021, together those 2 years, the fiscal stimulus was about 5 percentage points of GDP, with half of it for social assistance, education, healthcare, and the other half of that 5 percentage point of GDP for investment, for big projects. And so that.
Let me ask you this. Does the IMF treat Caucasus and Central Asia as 8 countries, each presenting very distinctive challenges, which is undoubtedly the case, however, does it also consider them together? In other words, when you meet, do you meet with them ever as a group to discuss the common approaches and so forth? To what extent, in other words, back to my question, is this a choir or a group of soloists?
Yeah, no, and Subir can say more about that, but I mean, it's both. I mean, and as at the IMF, we always look at what is happening in the country, what are the peculiar issues, situations. But clearly, I mean, we're also looking at this as a group, and actually, we have various meetings, events that we organize for this group of countries, because they have a lot of similarities too. And maybe Subir, you can say more about that.
Thank you, Ron. Yes. To answer your question, Fred, the way we organize, of course, there are the country teams dealing with individual countries, and then twice a year, during the spring and the annual meetings, we host a number of events where all the ministers and governors are invited to have a peer-to-peer exchange on issue. We think that's a very good way of sharing experiences, trading tips, and we just had a round of those during the spring meetings. Where we host them, and then we usually have a discussion around a topic or 2 topics, both in the spring and the fall, and we prepare some background material. But the idea is to have them discuss it rather than us sort of have a one-way communication on key messages, but rather them share experiences. For instance, we've had discussions around digitization, more recently around inflation, around the fiscal issues. So we do promote more and more those discussions. And I should mention, we also, as you know, perhaps you might recall, we have a new technical assistance center based in Almaty that covers the region and Mongolia as well. And that's also a forum for a lot of peer-to-peer exchanges where officials come together at high-level officials, mid-level officials, and they exchange tips on institution building, what works, what doesn't work, what they tried and did, and where others could learn from, and so on. So, and then we participate in a couple of other regional things. The CAREC Forum, for instance, we are active participants in the Central Asia Regional Economic Cooperation Forum, where the countries, of course, discuss with each other, and CAREC, of course, also has, for example, Afghanistan and other countries. separately, we host a meeting with the other IFIs involved in the region. Of course, our friends across the street, the World Bank, but also the European, the EBRD and other institutions, to make sure that we are also learning from each other, from what's going on the ground. So it's more than country by country. So I would say it's both, it's complementary efforts, so both taking a regional view and a country by country view, because obviously it's not going to be one or the other to be most effective in helping shape.
Let me ask about the human beings with whom you're dealing in country by country. There was a certain specific generation that took power basically 20 years ago or so, and they're still there. But they are gradually being diluted by a new generation of younger men and women who have a very different formation, both in their education and often in their professional experience. How strong is this new wave of men and women in the economies that you're studying? How strong is their voice today? And to put the same question in the obverse way, to what extent are the old dogs, if you will, still serving as a brake on development?
Well, as you know, we are civil servants, so we steer away from the politics, the overall. But what I can say is that in our interactions, sometimes we start dealing with some of the officials when they're relatively junior, including through our capacity development efforts, for example, or in other ways. And then over the years, they have risen to go on to be, deputy governors, deputy ministers, or even ministers and governors. So we have long relationships with many of the policymakers in the region. And I do not get the sense that the change is so much, in terms of opening up, in terms of integration, as much about personalities as about taking opportunities. And the world is changing and countries have to change with it. So in sometimes I've had personal interactions with officials who have changed their own worldview over the years when they have started, especially coming back to the whole issue of peer-to-peer exchanges. They say, oh yeah, you know what? For instance, we had a certain way of operating monetary policy, and now we realize the world is getting more complex and we need to adapt to that and start moving towards more exchange rate flexibility, towards inflation targeting. So it's not personality driven as much as it is driven by trying to take advantage of opportunities. And we certainly try to facilitate those exchanges with others. So I am optimistic. I feel that if we look at a common understanding of, and we have learned a lot as well, right? What works, what doesn't, what are the experiences? We keep accumulating that and we try to bring it to them. So we feel that that has quite a lot of traction. We have good relations with all of them and we are frequently there. Now we're also traveling again in the region, thankfully, because of the ability to travel more, pandemic easing. But yeah, no, it's really about persuasion and it's about policies, less so about people. At least that's my view.
I want to thank you both very much. And can I ask Ron van Roden and Subir Lall to tell us when will their detailed reports be available online and in print?
Maybe the regional report is now available for the regional economic outlook, as it's called, for the Middle East and Central Asia. So that'll be there. And maybe Ron can speak to his report on the country itself and the timeline you have in mind, Ron.
For Uzbekistan, yes. Thank you.
For Uzbekistan, like I said in the introduction, we have our board meeting to discuss the so-called Article 4 consultation with Uzbekistan. We have that tentatively scheduled for June 15, so the report should be available for public information shortly after that. but I mean, kind of a summary, what we call the concluding statement of the mission, was already published at the end of our mission in mid-April, which, like I said, summarizes the main findings that we see as the challenges and issues that face the Uzbek economy. So the summary is already out there on our. You can find that on the IMF's website. The full report will be there sometime in the middle of next month.
Let me conclude this very productive session. And first, I want to thank and congratulate you at the IMF for your continuing, really just fundamental research. No one else does it the way you do, and we're all in your debt for that. Let me conclude by noting that there is a meeting of regional presidents taking place shortly in a month or so, that there is evidence of greater interaction, especially among the leading economies, and I have in mind Uzbekistan, Kazakhstan, and Azerbaijan. They're definitely interacting more than they were a year or two ago. There is also evidence of change in several of the other economies. We haven't focused on Kyrgyzstan, but I think that's an interesting question today. And you've identified positive elements in several of the others. This all bears watching. It's not a static condition. I think the evidence that both Ron and Subir presented contains heartening elements. I mean, the fact that 2021 they did better than you all anticipated is I find very, very refreshing. This story is not over. It's in media res, and as they say in Latin. We're still in the thick of it, and we'll ask you to update us all again later. And meanwhile, thank you very much for what has been a long and very productive relationship. Thank you.
Thank you. Thanks very much. It was a pleasure.
Thank you very much for having us. We look forward to being back again with our next report next time. Thank you, Fred.
Thank you.